everyone, and welcome to Edison TV. My name is Victoria Chernik. I'm an investment director at Edison Group, and my guest today is Chris Tennant, who is a co-manager of Fidelity Emerging Markets company, the closed-ended fund listed on the London Stock Exchange. Chris joined Fidelity in 2011, coincidentally exactly the same year when the strategy was launched. He then became an assistant portfolio manager in 2019, and then he got promoted to co-manager of Fidelity Emerging Markets last year, when the lead manager of the fund, Nick Price, asked him to work alongside him. Welcome, Chris. Well, given the situation, given the war in Ukraine, what can we say about how do you manage this situation? How do you navigate the company and the portfolio given such a heightened geopolitical risk in Europe for emerging markets?
Yeah, I mean, firstly, it's obviously a very unfortunate and tragic situation, and it's been a very tough time for emerging markets as a result. I think if you look at what we've done in the strategy, if you go back to 2021, Russia was a large overweight for the strategy, and there were a number of reasons for that. We had a sort of a very positive view on the commodity outlook. The world was running out of various commodities: nickel, aluminium, tin, copper, for example, and so that was a very positive backdrop for the Russian economy. And secondly, the country had a number of extremely high quality assets in the mining sector and also in the banking space. So we had a number of long positions in Russia. So yeah, the situation changed in December when Russia started to build up troops on the border of the Ukraine. And at that point we took action in the strategy to reduce our country exposure, and we did that via an index short position on the Russian market. Yeah, and then fast forward to the end of January, and we had 17% of the strategy's NAV in Russian equities, and that was hedged with a 10% short position in this Russian index. That short position went to zero. We settled at a nominal value, which was effectively at zero. So that hedge would have contributed, had a 10% positive contribution to the company, and the 17% of assets that we had in Russian equities has been impaired to zero in the NAV. We still own the majority of that position. As the sort of war broke out, we did what we can to reduce that exposure, but the liquidity environment was obviously very challenging, very poor, so we were not able to sell too much of that position. And so as we stand today, the fund's exposure to Russia in the NAV is zero, but we do have those stocks sort of impaired to zero. So were there to be any recovery in Russian asset prices, then the short position is gone, and the strategy could sort of benefit from those positions that we have remaining in the portfolio.
Mm-hmm. Okay, understood. What about, do you talk to the companies on the ground? You probably do. What are they saying? What are you hearing?
So I guess the two key points to mention there are we've met with all of the major companies listed in Russia over the past couple of months. And I guess the key points from those meetings are that they're unable to pay dividends to foreign shareholders currently, and when that's the case, they will pay dividends into a sort of an escrow deposit. So were the situation ever to recover, we would still receive those dividends, but obviously they can't pay them today. And the second point to mention is that exports still are flowing out of Russia. There's been various sort of logistical challenges with ensuring cargoes, that sort of thing, but there's still markets for these commodities. They have to sell them at a discount, but you are still seeing gas, oil and metals flow out of Russia. and I think that will remain the case. There'll be buyers for these commodities. So yeah, they would be the two sort of key points.
Okay. What about, let's move from Russia and the Russian equities market to the broader emerging markets. This event, this war, brought huge implications for the whole emerging markets universe. So what ramifications are you seeing out there for the whole universe you are fishing stocks from for the fund?
So I think the main impacts have transmitted to other countries and regions via the commodity complex. So as I mentioned, the world was running out of a lot of commodities even before the crisis. Mm-hmm. The shock to supply chains has sort of accelerated that sort of market tightness in commodities, and so you've seen a lot of inflation, particularly in agricultural commodities, fertilizers, that sort of thing, a function of higher gas prices. So that has huge ramifications for various countries and sectors. If you take Brazil as an example, it's been a country that's had it for a long period of time, a very fragile sort of macro backdrop. They were at the worst point during COVID, running a 20% fiscal deficit, and that's turned to a surplus for the first time in more than a decade in recent months. So you've seen huge improvements in the macro environment, not just on the fiscal side of things, but in terms of the current account for these countries as well, also dramatically improving. So lots of countries that were previously fragile commodity exporters have got very sort of robust economies in this current environment.
Incredible turnaround within the few months.
It is, yeah. Yes. It has been incredible, and the opposite is obviously true for importers of raw materials, the likes of India, where this environment is a sort of a big headwind for the economy. Mm-hmm. So there's big country ramifications, but also big sector ramifications as well. So these prices will, particularly in agricultural commodities, wheat, for example, will flow into the price that consumers are paying for food. That puts a huge sort of strain on the emerging consumer. So at the moment, we have some concerns about some of the retail names. So Brazil, for example, we prefer to have exposure to the domestic economy via industrials, for example, rather than the consumer stocks, which I think are going to struggle during this sort of current environment.
Interesting. You've already touched on that, Chris. So the events and geopolitical evolving situation is bringing basically problems within the sector, but it's also bringing opportunities. And you touched on some, like Brazil and commodity-rich countries benefiting at the moment, and they will be bringing sort of performance to the portfolio. What kind of other opportunities you're seeing? Like if you can list a few for investors to look out for in your portfolio.
Yeah, so the first one, as I mentioned, was countries such as Brazil. South Africa would be another example where previously these were sort of basket case countries with really sort of difficult sort of fiscal environment. But we have domestic exposure to these countries for the first time in a number of years. I mean, another area where there's a lot of attractive opportunities is the Middle East, with Kuwait and Saudi Arabia entering the emerging market benchmark for the first time over the last few years. You're seeing a big sort of IPO pipeline in these countries, and some very attractive businesses coming to market. A good example of one that we participated in would be Fertiglobe, which is a UAE listed urea and ammonia producer. And these types of companies benefit because, being based in the Middle East, they have access to cheap gas prices for their input costs, and they're benefiting on the revenue side of things from higher higher prices in ammonia and urea. So you're seeing margins expand in companies such as this one. So yeah, there's a lot of opportunities in the Middle East, but it is quite a rich market in terms of valuation. So we're having to sort of hunt hard for the best ideas in that region. And then finally, where we see a lot of emerging opportunities would be in China. It's a market that's sentiment has been incredibly negative. The internet sector has derated to its lowest valuation ever, and it was an underweight for the strategy at the start of the year. But we've been adding to our China exposure in early March. So that would be the other area where we're seeing a lot of attractive opportunities. And to name a few sectors, so the internet space, as I mentioned, is one, but also in real estate. We've been incredibly skeptical on Chinese real estate for a number of years. The strategy was in the past short Evergrande. We're short a number of property developers that we believe are insolvent. But on the long side, we think the changes that have been made in the property sector with the bankruptcy of Evergrande creates a lot of opportunities for the financially robust businesses. So we have a long position in China Overseas Land, which is one of the big beneficiaries from consolidation in the Chinese property sector.
Yes, fascinating, Chris. Yes, that's been a good overview of the company and the way you manage the portfolio. Emerging markets remain a huge universe, and the area-wise and the population-wise, these are the largest, probably they're the largest in the world. Compared to they dwarf even developed markets. Right now, and looking forward, they're going to grow even further, so there are opportunities there. Well, thank you for talking to Edison TV. That was Chris Tennant, co-manager of Fidelity Emerging Markets company.